is associated with some kind of crisis. There just isn't a crisis at the moment in the US economy.
You said something about housing, that you think on the margins, the liberalization of the mortgage market and the housing sphere would actually potentially even lead to stabilization in prices, actually the opposite of what some people would argue. Can you walk us through that? I mean, do you think that in some ways it will reduce inflation further if the Fed normalizes rates at this point?
So I think that the mechanism here is via the nonsense of owner's equivalent rent, which is, let us remember, an entirely fictitious price and a quarter of the consumer price inflation calculation. And of course, that is derived, sort of, from the rental market. So if you've got a situation where people are delaying buying a house and are therefore, perforce renting a house, that increases rental demand, that increases market rents, and that's magnified through this fantasy of owner's equivalent rent. And so we know owner's equivalent rent has been distorting the headline CPI numbers. We know this is due to a tight labour market. Now, I've got a lot of sympathy with people who are actually renting because they are having to pay higher rents. The people who own their own homes are not actually paying this. So that's then being created by policy which has pushed people out of owner occupation and into renting. If we can now reverse that, hopefully that calms the rental market down, and the effect of that will be magnified in CPI by reducing owner's equivalent rent.
Paul, I'll say it on behalf of everybody. We love your work, buddy. Thanks for being with us. Paul Donovan of UBS on the latest with the Federal Reserve. Next time, we've got to talk a little ECB, the fantasy of owner's equivalent rent.
I love everyone's private gripes. You get this fantasy of OER and R-Star in the basement and all these sort of passionate feelings from economists.
Speaking of passionate and bullish, we'll speak to Jay Pawlowski at TPW up next from New York City. This is Bloomberg.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry. And
crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Well, I think what's happening is we're starting to bring realism into the discussion. I mean, I think understanding the global energy system, the scale of that system, the important role that it plays in everybody's life around the world, and then thinking something that's been built over 150 years, trillions and trillions of dollars of investment that's playing such a critical role in the economies around the world, how you transition out of that system. And I would say transition from a higher carbon emission system to a lower carbon emission system. We started out with a very narrow solution set focused on wind and solar and EVs, and assumed or aspired that that would address the total set of the issues, and it doesn't. We need to be more realistic around, to Patrick's point, there are a lot of solutions that are going to be required. We should stay focused on the problem statement, which is emissions, and reducing those emissions, and less focused on exactly how to achieve that, and let every company, every sector, all technologies compete for the most cost-efficient way to reduce those emissions, and we will make progress much faster, which will mean making today's system more emissions efficient while we introduce new systems that have lower emissions. And then with time, you will transition and we'll make progress.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
I'm optimistic now that we might be near the end of this big rotation.
It could maybe make sense for equities to pull back just a little bit.
I don't think the market is in trouble here. We do think the market ends higher into the end of the year.
The economy is really fundamentally in a pretty good spot. And therefore, the stock market should be in a pretty good spot.
The most bearish thing you could say is that everybody's bullish right now.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abram.
So let's talk about one. Here's a question that's near and dear to your heart. You have a lot of children.
Yes. I'm trying to set a good
example. The birth rate is down in the U.S. What needs to change so people start having more children?
Yeah, so this question has troubled me for a long time because you can look at the demographics. It's a very slow-moving ship. I mean, you know who's going to be an adult in 20 years based on who was born last year. So, if you want to, I think have a good approximation for population, really look at how many babies were born last year in a particular country. Multiply that by life expectancy. That's the number of people that will be adults in that country. That's the steady state population if birth rate remains constant. Now, birth rate is not constant; it is dropping. So you look at the second derivative of birth rate, and actually we see an acceleration in the drop in the fertility rate. Second derivative of the fertility rate is very bad. So where does this lead? This does not lead to a greater civilization. This leads to a civilization that potentially dies not with a bang, but with a whimper in adult diapers. That is a sad ending.
So obviously we have countries that, like Korea, used to have a birth rate of 6. It's now 3/4.
Yeah.
Here's a light question for you. What do you
come
think
pick me
are
up,
the
I'll
biggest,
give you a baby, says one
what do you think are the...
That is one of the things that says on the screen.
Yeah. I don't know if everyone heard that. You want to read it?
It says, Elon, come pick me up, I'll give you a baby. Thank you.
Okay.
Well, I mean, I certainly encourage everyone in this room to have at least 3 children. Look, baby's got to come from somewhere, you know. I think we just want to have, I don't know, I think we want to have like a slightly increasing population, not a plummeting population. You know, and I think this applies to all countries and cultures. Like, I don't think we want any country or culture to disappear. We want them to ideally flourish and not disappear. So, in fact, one of the things that is overlooked by probably most historians is the role of low birth rate in the decline of civilizations. So around, I think it was around 50 BC, Rome passed a bill to give a bonus to any Roman citizen that would have a 3rd child. So this was a birth rate was a problem in Rome in 50 BC. The Romans weren't making Romans. The same is true of ancient Greece. So there was a time from about 800 BC to 300-ish BC where the Greeks had a lot of kids and a lot of surviving kids. Like the birth rate far exceeded the death rate, which is why you had Greek cities popping up all over the Mediterranean. But then I think basically it seems to be that prosperity destroys the birth rate. So when a civilization feels like it has no meaningful external threat and is very prosperous, that is what causes the birth rate to plummet. Somewhat counterintuitively, you think, well, if you've got more resources, surely that would lead to more kids. In fact, it is the opposite. The more prosperous a civilization, and the more a civilization feels that it does not need to defend against external threats, the lower the birth rate.
Or that you get some sort of ongoing increase or steepening in the yield curve on inflation concerns, or is this just a blip as people recalibrate? Answer is we have no clue, but there is a feeling that on the margins, the greater risk that is underpriced in markets right now is some sort of sticky inflation that some people are saying, at least publicly, is dead.
We'll talk to a man who's not concerned about any of that. Coming up in just a moment, Jay Pawlowski of TPW, with stocks coming off their 39th record high this year. We'll catch up with Poonam Goyal of Bloomberg Intelligence as Nike is attempting to stage a comeback, and Matt Hornback of Morgan Stanley calling for a string of 25 basis point rate cuts. We begin with our top story. Stocks coming off their 39th all-time high so far this year. Jay Pawlowski of TPW writing the Fed's move is likely to force even the die-hard recessionistas to give up on that point of view. There is no sign of recession anywhere. There is no major imbalance in any part of the U.S. global economy. Jay joins us now for more. Jay, welcome to the program. I'm going to repeat that line again. There is no sign of a major imbalance in any part of the U.S. global economy. Jay, China, discuss. What's happening in the world's second largest economy?
John, it's growing at almost 5%, which is more than twice as much as the number one economy in the world, the United States. And for all the doom and gloom in China, look, as an investor, the question is, what's in the price? And when you look at how China performs equity-wise, if you look at the valuation, my point is, one example is Alibaba, right? The big tech stock. We're believers in a two-tech stack thesis, China walling off its tech, U.S. walling off its tech. And Alibaba just announced that it now has the world's leading large language model, open source large language model. It's buying back stock at record levels. It trades at a fraction of the valuation of its U.S. peers. And so to us, it's all in the price. And just note that K-Web was up 4.5% yesterday. It broke back above its 200-day moving average. And it's emblematic of what we want to do right here. You talked earlier in the lead up that I don't really care about a lot of what you and Lisa have been discussing. And, you know, that's not quite true, but it's true.
But mostly.
Hey, Jay, do you want to come back on the show again?
And I would just make, 2 points before we talk about the investment opportunities that we see at TPW Advisory. Point number one.
Jay, it's not a presentation. Just so let's step at a time. Let's just start with your views on China, and then Bramo wants to follow up.
Well, hold on a second, Jay. Actually, when it comes to China, I just have one word or one company to throw out at you, Mercedes-Benz. How do you understand that with all of this optimism that you just expressed?
Well, I expressed optimism about the tech stack and Alibaba. I didn't say anything about auto companies. Look, we're big, we have a TPW 20 model portfolio, which is focused on future innovation and climate. So we're very focused on the China's leadership in clean energy, renewables, and EVs. And the simple fact is that China is eating the lunch of pretty much everyone but Tesla in terms of EV production, activity, sales, innovation, et cetera. China is the world's innovator in clean energy, and the European auto companies are just watching their market share in China, which is a critical market for them, just simply disappear. And it's not even Mercedes-Benz, it's Volkswagen, which is out talking about laying off 30,000 employees in Germany for the first time in its 90-year history. There's a reason why Mario Draghi came out last week with a European competitiveness report and said that Europe needs to be more like what the U.S. has been doing. Public-private partnership, venture capital, innovation at scale. And the automakers are certainly emblematic of that concern for Europe.
So, Jay, for people seduced by your view of the world, I know it's a multi-year view, and a way of expressing it is the commodity market. Iron ore off the highs of the year, base metals, copper off the highs for the year. What kind of moves are you looking for in commodities, Jay?
Yeah, John, you no surprise, hit the nail on the head. That's where we want to focus right now. I wanted to mention the two strengths. One is in the global economy, absorbing one of the most aggressive rate hike cycles in modern history without a recession. That's something we need to pay attention to. And likewise, in the equity markets, particularly in the U.S., new all-time highs, you noted it, 39 all-time highs this year. While tech, the leadership sector in the lead dog, NVIDIA, is down 20% from its high. We have to respect the fact that trends are powerful and they are moving in the right direction, both in the global economy and in the risk asset markets. So what do we want to do here? How do we want to invest? We want to sell the things that have done well on the idea that there's going to be a recession, because there's not. And so we don't like fixed income. Lisa talked about, 3.7% on the 10-year. Unattractive if the neutral rate is 3%. We want to focus on the context of a long cycle. Sustainable, soft landing equals sustainable equals our global macro blue sky outlook, which we've talked about, 2023 to 2027. We're now focusing on that, not the next quarter, not the next 6 months, the next several years. We believe we're in a setup. And their commodities look really, really attractive. B of A pointed out allocations to commodities are at a 7-year low. Hedge funds are their most short commodities they've been in a decade. So there's a real opportunity there. There's a real opportunity in buying the laggards, things like small cap, things like the non-U.S. markets, which are still 10 to 15% off their highs. China is 40% off its high. I'm not going to say it's going to go to a new high, but we want to be buying the laggards if this is going to be a long cycle, a sustainable growth path, a Fed cutting through 2026. That's what investors need to be paying attention to. We wrote a piece several weeks ago, zoom out, not in.
Jay, all of this leads me to question what your view is on utilities, one of the most loved areas out there. And I know that sounds like a hyper-specific point with a lot of the calls that you're making, but it seems like it's a 1-2 punch. They've done really well just as a performance, but also they would benefit as a bond proxy. Both of those reasons, how much do you think that very loved trade is not going to do so well?
Well, utilities, in our view, have done well, in part because they're viewed as a recession hedge, and in part because they are viewed as being in one of the hot sectors, which is, power generation for the data center and data centers in the AI revolution, which we're big believers in. We own an ETF called GRID, G-R-I-D, as our way to play this. And GRID just broke out and is at a new all-time high. So that's the way we're playing it. We don't really like the utilities at this point because they've been pretty well exposed, and we don't think rates are going lower, and we don't think there's going to be a recession. Rates on the long end, not on the short end, obviously. So what we like is industrials, right? I think one of the surprises in the next couple of months is that the ISM for manufacturing is going to break back up above 50. And you look at what's leading. I made the point about markets at all-time highs while tech is still well off its all-time high. Industrials, financials, real estate. There are multiple sectors that are breaking out. And one of the things we like, in addition to industrials, we just added a position, is in consumer discretionary. You talked about FedEx. Amazon is very attractive. Tesla is very interesting here. They make up 40% of XLY, the consumer discretionary ETF. And that's an example of where we're moving to as opposed to where we've been.
This was Jay Pawlowski's TED Talk, brought to you by TPW. Jay, it's good to see you. As always, you're a good friend. You're welcome back anytime. Appreciate it. It's pretty decent, wasn't it? The bullish outlook for the next several years.
Just imagine him whipping out his pointer, the PowerPoint presentation. This is the blue sky outlook that we are looking for. And you recessionistas, Lisa Abramowitz, let me tell you.
Did that feel personal?
Yeah, no, I'm actually not a recessionista. I just try to understand where people's logic might not necessarily be completely holding together.
not having this conversation again. Up next on the program, let's get to your Bloomberg brief. Let's cross over to Danny Berger. Hey, Danny.
Hey, John. The EU is planning a new 35 billion euro loan to support Ukraine. European Commission President Ursula von der Leyen announced the plans earlier this morning after meeting with Ukrainian President Volodymyr Zelensky. Under that arrangement, the loan will be backed by profits from frozen Russian state assets. The figure is part of a G7 plan to raise $50 billion for Ukraine, which has seen months of negotiations over the split and structure of the loan. Speaking at an anti-Semitism summit yesterday, Donald Trump said that Jewish voters would, quote, have a lot to do with a loss in his presidential run. He repeated the claim that he had not been treated right by American Jews after his support of Israel. Trump spent much of Thursday on an outreach campaign to Jewish voters, giving speeches at both that anti-Semitism forum and an event hosted by the Israeli American Council. And Dodgers superstar Shohei Ohtani made baseball history last night, becoming the first major league player to hit at least 50 home runs and steal 50 bases in a season. He also went 6 for 6 with 10 RBIs, while becoming the first big league player to hit 3 homers and steal 2 bases in a game. And that's your brief, John.
Danny, thank you. Let's pause. This guy is a video game character with cheat codes. That's what it looks like every time I see him. It's just amazing.
That's brilliant. I love that characterization. LeBron James, King James, came out on X and said, this guy is unreal, all caps. Wowzers. Lots of raised hands.
TV ratings for this guy, they're going to rock it.
You know, all I can say is my 12-year-old son last night, so excited. He was like, it's 50. He got a 50-50. He's doing the 50-50 split. And then he was like, it's 51-50. And it was so excited. You know, think about the new generations that he single-handedly is bringing into this sport.
How late did that game go last night?
I don't know. I was asleep.
That's our problem, not MLB's. Up next on the program, a tight race in North Carolina.
In just, I believe, 44 days, going to turn North Carolina red and send Kamala Harris back to San Francisco, where she belongs.
That conversation just around the corner. We'll catch up with Anne-Marie in North Carolina in just a moment.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Looking to get you to the weekend with stocks just about negative by a third of 1%. Coming off all-time highs. Am I speaking for myself too much?
You know it's that kind of week when you're
honest.
saying that again.
just about getting myself to the weekend. About an hour and 40 minutes left of this.
You're speaking for both of us. It's been a really long week.
25 or 50, it's felt like it's been going on forever.
Well, it was going on forever, and now we get to talk about it all over again for December.
Take a deep breath and work out what November 7th looks like. I've got no idea. Politics is going to be a big piece of that puzzle. Under surveillance this morning, it's a tight race in North Carolina.
It is great to be in Raleigh. We're in just, I believe, 44 days. Going to turn North Carolina red and send Kamala Harris back to San Francisco, where she belongs. Now let's talk a little bit about why we need to send Kamala Harris back. And Kamala Harris still refuses to really talk to the American media. It suggests maybe she's got something to hide, and we all know that what she's hiding from is that she is a dangerous San Francisco liberal, now pretending that she is a moderate.
So here's the latest. Trump and Harris neck and neck in the battleground state of North Carolina. New polls from Emerson College and The Hill showing 49% of the state supporting Harris, while 48% back Trump. Anne-Marie joins us now from Raleigh, North Carolina for a whole lot more. Anne-Marie, good morning.
Good morning, John. This race just got a lot more tighter and a lot more complicated for the Trump campaign with this damaging report coming out of CNN about the gubernatorial candidate, Mark Robinson, on the Republican side. This individual backed by the Trump camp. If you read this report, you could look at some of the salacious, offensive, and controversial remarks that CNN was able to leak biographically from Mark Robinson to this username. He has come out and called this tabloid trash. At best, it's a distraction for the Trump camp. At worst, it becomes a liability. Last night, Crystal Ball, Larry Sabato, they came out after emergency meeting and have moved now the governor's race in this state from lean Democrat to likely Democrat. And the question everyone in politics asking now is whether or not this is going to tarnish former President Donald Trump's chances of winning the state, which J.D. Vance, who you just heard from, he was here in North Carolina a few days ago and said it's going to be very challenging, very hard to win the White House without winning these 16 electoral votes.
Anne-Marie, that's exactly where I wanted to go. Can you just put into perspective how important each swing state is and why North Carolina is really a linchpin in any potential strategy?
North Carolina will be very challenging to lose for the Republicans and not have a path forward. We should note this has been in politics called Lucy with the football, very elusive for the Democrats. Since the late 1970s, they've never won North Carolina except for once, 2008, the first time, the first round for former President Barack Obama. But the polls right now are so tight, which is why any salacious story that comes out, anything that can move individuals, you are going to see politicians harp on. You mentioned a few polls, but I look to the Carolina Journal poll. It has them both neck and neck, but 6%, they say, of North Carolina voters are undecided today. Could a story like this move them potentially into the Harris camp?
Anne-Marie, we played that sound from Senator Vance, who's making the point that they've been hiding from the media. Axios has made the same point. The Harris-Walz media strategy, hide from the press. And the lead paragraph of that story, and we went through the stats on this program yesterday, the Harris-Walz ticket is on pace to do fewer interviews and press conferences than any major party's presidential pairing in modern U.S. history. The question I would have, regardless of what I think about whether they should or shouldn't, they should be speaking to the media more. Is that strategy working?
Well, at the moment, they're neck and neck in key battleground states. So potentially it is not working. What you see a lot of times in the crosstab of the polling is that voters right now want to hear more about policy, and it's hard to talk about in-depth policy when you're just doing set pieces when it comes to, say, campaign rallies. And we've seen her do a set piece last night. Not exactly an interview, given the fact that Oprah Winfrey spoke at the DNC and is supporting Kamala Harris, but she did go out there in front of more friendly media. These are with voters who are already going to vote for her, not sitting down with the national press. I believe they're doing this to just play it safe. There's some 40 days left to November 5th. At this moment, they want to make sure they don't do anything that could potentially hurt their chances.
AMH, looking forward to the coverage a little bit later. Anne-Marie, thank you. Tune in 3:30 Eastern for Anne-Marie's interview with the North Carolina Governor, Roy Cooper, a conversation you do not want to miss. Joining us now, Bloomberg's Joe Matthew from Washington, D.C. Joe, let's talk about some of that data that came from Axios just yesterday. I know you've seen the numbers. Let's share it with the audience once more. Harris has been a candidate for 59 days, Walz for 44. During those 59 days, Republicans Donald Trump and J.D. Vance have participated in more than 70 interviews and press conferences with TV and print reporters, while Harris and Walz have taken part in 7, according to Axios analysis. Joe, does the electorate care about those numbers?
I'm not sure. I don't know if she's returning your phone calls here, John, but this is clearly a strategy to not say more than you need to. I don't know who's looking for all of these interviews beyond myself, beyond you, beyond the Trump campaign that's really tried to make some hay out of this. But I don't know how many people are sitting around waiting for hard-hitting interviews. A lot of people watched this Oprah event last night. Kamala Harris made news at the NABJ, and I'm not here to apologize for her. I would love the opportunity to ask some hard questions of Kamala Harris. But look at the polling numbers. If you're a campaign operative, and you're looking at the remarkable turn that Kamala Harris has brought to Democrats at the top of the ticket since Joe Biden dropped out of this race, watching her, and I can cite the polls that we've seen in the past week, catching up with Donald Trump on the issue of the economy in a state like Pennsylvania, why would you put your candidate out to have so-called hard-hitting interviews with interviewers who want to get you in a gotcha question? Now, I'm a member of the media, and I'm the person who would be asking questions in an interview, so I'd love to see this happen. But if you put yourself in the shoes of the campaign, you have to ask why.
Just real quick here, Joe. How much, though, is this important, not necessarily for the rank and file, but for some of the business support, for some people who are actually looking for more specifics on policy and don't feel like they have a good sense of it?
Well, now you're getting to it. And look, this is going to be one issue for people who watch and listen to Bloomberg, who are looking for answers on things like taxing unrealized capital gains. We still don't know if Kamala Harris would pursue that Biden-era initiative. When it comes to the corporate tax rate, some of these other ideas, for instance, as opposed to more broad strokes like stopping price gouging, for instance, or incentivizing housing. These questions need to be answered, and we may not get another debate for that to happen. So, look, we're 46 days out to Anne Marie's point. Some blanks need to be filled in, but we'll see how many actually get to that point between now and November.
Hey, Joe, appreciate your time this morning. Thank you, sir. Joe Matthew. Out of the nation's capital in Washington, D.C. Up next on this program, Nike shares rising in the pre-market, up by more than 6%. The company ousting its CEO. We'll talk about that next on the program.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
We're down 1/3 of 1% on the S&P 500. The opening bell is 2 hours away. We're down 1/2 of 1% on the Nasdaq 100. We're down 1/3 on the Russell on the small caps. The leadership yesterday came from big tech, which was unexpected because yesterday morning, early on, we saw the Russell, the small caps ripping. The equity futures were up by something like 3 percentage points, and then things started to change. Bonds drifting lower, yields pushing higher, and the bond proxies on the S&P 500 started to underperform.
How much is this buy the rumor, sell the news? And how much is this the beginning of something that's stickier, a trend where you do see bond yields in the long end start to creep upward? We won't know the answer. It does seem like today the mild, less underperformance in terms of the stock market is probably from the Russell 2000, and we're hearing plenty of people seeing a lot to like. That said, it really matters what the economy, how the economy shakes out. And that, I think, is what the bond market is depending on as well.
Well, let's sit on the bond market and let's bring up treasuries together. We'll go through the 2-year, the 10-year, and the 30-year. And I want to separate what's happening at the front end of the curve and what might happen at the longer end of the curve. The front end of the curve, this was Subhadra Rajapaksa of SocGen yesterday, anchored. Anchored because we have this very well-established reaction function at the Federal Reserve now. We won't respond to strong data. We will respond to weak data. So what happens if you get an upside surprise on something like jobless claims? You're not going to get a big move at the front end of the curve. The flexibility is all at the longer end. And this is why these Subhadra Rajapaksas of this world are looking for more flexibility at the longer end. High yields, steeper curves, driven by the long end. Not steeper curves just driven by the front end, but driven by the longer end, selling off and yields climbing on things like 10s.
This is the argument for why money market funds could be a little bit stickier than some people think, simply because that front end is still offering value relative to the uncertainty there of the long end. Key question to me will be, is there a feeling that inflation is going to tick up? Is this going to be fiscally driven, the uncertainty around fiscal policy, and how much more volatility, actually, does this uncertainty about where we're ending, the sort of so-called elusive neutral rate, how much does that really get accelerated heading into the election? And I know, if AMH were here, she'd say, what about the election? And she's
right.
Right. This is actually one of the key points that people are looking at for volatility.
Is it tradable right now? I think it's really, really difficult to trade on the election at the moment. That's the difficulty that people are having going into this. These campaign promises, they're huge. Every time there's a rally, the number goes up $1 trillion. How realistic are these campaign promises? I remember the piece from Goldman recently. You're looking at campaign promises, and then you look at the prospect of them becoming legislative reality, and it's very difficult to work out how much space there is between the two.
And then you start looking at what's the alternative. I mean, that's the other argument, right? People who wouldn't necessarily go into bonds because they're concerned about the fiscal picture go into what? Stocks?
Gold.
Gold? I mean, this is sort of the key question. What's the offset to it? European auto manufacturers? So these are some of the questions that people have at a time where it's difficult to trade. Nonetheless, a question of where the overweight goes. What you're seeing is money into bonds and money into stocks, and basically everyone's calling it a day.
And money back into the dollar as well. Let's finish on foreign exchange together. Dollar yen with a real breakout. It's a clean break of 144, 144.37. That currency pair on the session up by 1.2%. That's a weaker Japanese yen. I'll give you some numbers here. 2.5% is the move on the week. That's the worst week for the Japanese yen going back to January of 2024. January of this year. This has been a really painful week for the Japanese yen, and this one has been very volatile over the past few weeks.
This was sort of consensus. People didn't expect them to hike rates at this latest meeting. That said, because of some of the rhetoric, it seems like people are pushing out their expectation for the next rate hike until the end of the year. How much did the Bank of Japan feel like they had some room to wait simply because of the strength that you saw earlier in the year in the yen. The fact that some of that weakness had been pushed back. And I guess that's one of the questions going forward. How much is that the sort of data dependency that they have? How strong or weak the yen is versus the dollar?
That's the Bank of Japan decision. Let's talk about the Federal Reserve. Under surveillance this morning, Donald Trump calling the Fed's half-point rate cut a political move, saying a quarter-point cut would have been the right thing to do. This coming after President Biden said the rate cut was a declaration of progress, not mission accomplished in the White House just yet.
What's the difference between declaration of progress and mission accomplished? I mean, isn't everything just progress towards something else? That's very philosophical.
This is very deep, yeah.
I'm not going to go there.
7:30, move on.
This is something that's going to be interesting to see at a time where increasingly it's being politicized. We almost expected this. I mean,
of course.
It's sort of, at this point, what do we make of some of the political discussions around the Fed other than, Joe Biden saying that he hasn't met with Jerome Powell, even though he has?
I'm not saying this is economically sound, but I did think that it was politically quite astute for the former president to say what he said when he said that the economy must be really bad or they're doing it for politics. It's one or the other. It's difficult to argue the politics of that on the campaign trail.
I would argue with that, yeah, and I would say that sounds about right. And you saw that from other people who potentially might be Treasury secretaries under Donald Trump come out with something similar. Maybe the Fed knows something that we don't, and the economy is falling off a cliff. Otherwise, why would they exactly do this? I think it's politically savvy. A question of how much it actually resonates with people is a big one. And then he went on to say that inflation was dead. So, it's sort of, some wins, some losses.
Politically savvy, but maybe not economically sound. But on the campaign trail, as we've seen from both candidates, often that doesn't seem to matter so much.
Yeah, sort of consistency and relevance. I think that we're all getting ready for this to wind up too. 25 or 50 or the election season, putting it behind us and understanding what's going to happen next.
November 7th is going to be fascinating. It really will be. Let's turn to this one out of China. Bloomberg reporting that regulators in China are considering removing some of the country's largest restrictions on home buying. A new proposal would ease restrictions for non-local buyers in China's largest cities. They keep moving the needle, or at least trying to, over in China.
This, to me, is surprising, though, because they were trying to move away from something that people thought was a housing bubble. This was the one lever that they were using as a stimulus again and again over years, and they realized they had a problem and needed to move away from it. The fact that they're going back to this, to me, smells of desperation. The fact that they're not going to go toward direct subsidies, which they think are a cancer of capitalistic societies like the United States, and that instead they're going to go toward what they have done in the past that has led to cities that have been empty, is sort of a key question of how much they can really generate the kind of activity they're looking for.
What was that phrase that homes are meant to be live in and not invested in? And it just feels like we're going to the latter again and not the former.
It feels like the easy path out versus some of the harder paths that would go against some of the edicts that we've heard from Xi Jinping.
This is another one of those things that it comes down to the election in 2025, and I've seen several economists make the connection. They've drawn a line between the two. They've basically said they're going to hold off on fiscal. Part of the reason is given what you said. Second reason is the election. If you find out you've got Donald Trump in the White House, the prospect of higher tariffs, you need to have some ammunition ready to go to ease if you have to in 2025.
On a broader level, I wonder how much we're seeing decisions delayed that are pretty considerable until after the election, and how much you're going to see a real rush of activity one way or another, just with that certainty. Even though, albeit we still don't know policy, et cetera, but there is a big divide on some key issues.
Should we talk about your favorite issue, the airlines? Let's do that. The JetBlue CEO, Joanna Geraghty, is making a bigger push into premium offerings after its merger with Spirit Airlines fell through. The company planning to build its first ever airport lounges. Geraghty caught up with Lisa early this week.
We've definitely had a number of challenging items over the last few years, a failed transaction, actually failed 2 transactions, but we're focused on getting back to the core, our roots. Going through a transaction can take its toll on an organization. It also creates a level of distraction, and so we're very much focused on executing our Jet Forward plan and bringing JetBlue back to what it was when we were founded, around bringing humanity back to air travel.
Lisa, we've been talking about this airline for quite a while. This airline, to me, is a premium offering in a budget wrapper. And I've always wondered what they're going to do about the branding in the years to come. It hasn't happened, and I'm wondering if it will now.
I'm not sure, because ultimately they're trying to get back to a roots of value. And if you look at where they are heading, it's often to vacation spots, and they're catering to a leisure customer. Even the lounges. JFK and Boston's Logan Airport are the first that are going to be unveiled. And then they're looking at Orlando and Fort Lauderdale, not exactly the business hubs that you would expect. So it's catering to someone who wants to upgrade their leisure experience, not necessarily compete with the Deltas and the Uniteds of the world. That said, there is a real tension here, a reality of the travel industry and frankly all industry, which is well-heeled customers can pay and the others can't. Margins are getting thinner, workers are getting more expensive, the overhead costs are getting more expensive. How do you turn around a profit that has been elusive for this company going back to 2020?
I'm sure you talked about the failed transaction with Spirit. Do you get the sense that's turning out to be a blessing in disguise, given the strategy now?
I did not say that. We didn't necessarily go into that. It does sort of highlight the inability and lack of certainty around transactions, and the fact that, you know, she said it takes a toll on organizations, and that they're moving forward with trying to lean into what their strengths are and potentially expand and monetize some of those issues. Credit cards, a key aspect of that, and these lounges can be paid for individually, not just as part of some sort of loyalty program.
Interesting. So they might be quieter, not as busy as maybe some of the other airport lounges.
That was something we discussed.
Delta. Anyway, let's park that. It's a wonderful exchange. Check it out on Bloomberg.com and on the Bloomberg terminal to watch that in its entirety. Let's talk about Nike. Shares rising in the pre-market. The company ousting CEO John Donahoe and bringing back longtime executive Elliott Hill to try and turn around the struggling brand. Nike slashed its revenue forecast in December, losing ground to competitors including Adidas, On, and Hoka. Poonam Goel of Bloomberg Intelligence joins us for more. Poonam, that stock is up by 7%. Is that stock up now? This is difficult, I know, because the other guy's gone, or because of this new guy?
I think it's because of this new guy. This new guy has 32 years of experience at Nike, so clearly a veteran who knows the DNA of Nike, and he can bring, hopefully, Nike back to what it was, focusing on sports, focusing on performance, focusing on the core, the product of Nike, which makes Nike what it is, and really differentiates it from the competition.
What have they done wrong that Adidas and On and Hoka have done right?
Well, it goes back to what he did as soon as he joined back in 2020, where he basically pulled out of wholesale. So when you think about the American consumer and where they can get Nike and how prevalent Nike was in their minds, it was because it was everywhere they went. If you went to a Foot Locker, it was predominantly Nike. Now, if you go to a Foot Locker, it's Hoka, it's On, it's Adidas, it's Nike. They're balanced, so the consumer has more choices. So that was a big mistake. And yes, they've pulled back to come back into the wholesale channel, but still, you know, others have taken share. So now what? Now it's back to the product. They have to prove that they can have innovation and they can compete with these newer launches of other competition.
Poonam, I've been struck this year by how many executives have been pushed out or forced to resign in some capacity, and particularly in the retail sector. What do you make of that? I mean, pretty much across the board, we've seen an increased level of these at a time where companies are trying to go back to their roots.
Well, part of it is cost cutting, right? So since the pandemic, there's been a bigger focus on profitability. In that process, there has been more turnover and more executives have left. Part of it is also new management, right? Many companies have had new management, new styles of working, and when things don't connect, there is going to be a fallout. So it's a combination of the two that I think has caused all of this.
How much does this also have to do with the fact that higher yields, and I don't want to go back saying it's all about 25 or 50 with the Federal Reserve, but how much has to go to the fact that you actually have a borrowing cost? That suddenly there is this sort of gut check about your ability to survive at a time when you can't just borrow your way out?
Well, you know, I'd say that's the case for smaller, younger companies that don't have a big cash balance. But for companies like Nike and Amazon and others, that shouldn't be a factor on how you make your decisions to invest into the future. So I think healthy balance sheets, it's not a concern.
Got to leave it there, Poonam. Thank you. Poonam Goel there on Nike. Nike up by almost 7% at the pre-market. The hope here is this is the beginning of a turnaround after missing a massive growth area, which was really something they should have dominated given it's the roots, the fabric of this company.
Yeah, and it's the reason why people are celebrating maybe this return. Comment from a viewer. First you were in Shogun, and now you're pronouncing Adidas like you're European. You have no shame.
You know what? I heard the same thing. I used the Adidas, which is the American pronunciation, and then you went with the European, the German.
That was deliberate. That was trying to correct you. To basically say, you know, come on, if you're going to do the American version, I'll do the European version.
When I say aluminum, do you know how much criticism I get?
Yes, I do.
From people back home. It's like a list of messages just pop up like that.
Aluminium.
Adidas. Okay, let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Israel carried out extensive airstrikes across southern Lebanon yesterday, calling it a new phase of its conflict with Hezbollah. It follows 2 deadly operations in the region in which pagers and other communication devices were detonated. Hezbollah Secretary General Hassan Nasrallah is promising retaliation against Israel. Prospective OpenAI investors will find out today whether they'll be part of the latest funding round. That, according to people familiar, one of the people said that the $6.5 billion round is oversubscribed by billions. Several strategic investors that may get access include Microsoft, which is already its biggest backer, along with newcomers NVIDIA and Apple. OpenAI declined to comment. The Telegraph reporting about big changes coming to Wimbledon. The All England Club is set to get approval to build 39 new grass courts. The development would involve the creation of an 8,000-seat stadium just across from the existing Wimbledon site, delivering $37 million of annual benefits. And that's your brief. John.
Hey, Danny, thank you. Appreciate it. More from Danny in 30 minutes' time. Up next on the program, price for perfection in the bond market.
We still think that the market is overpricing cuts for next year. From here on, they're going to be very deliberate and data dependent.
Matt Hornback, Morgan Stanley, up next.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in. We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Or other authorities.
Could face bigger challenges next.
It was going to keep rain World Cup. This is a 3
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
So Mike Ferrari of JP Morgan nailed this call for this week at the Federal Reserve. He was looking for 50, he got 50. He's looking for another 50 at the next meeting in early November. He says it's contingent on further softening in the 2 jobs reports between now and then.
That's actually becoming it's sort of a splitting the Wall Street type of moment, but you're seeing this among a number of banks. They're saying it doesn't take much to get this Fed to move more aggressively, to get back to neutral more quickly, which is the reason why you've got JP Morgan and you've got Bank of America both calling for 75 basis points more of cuts so far this the rest of this year.
If you're just joining us, welcome to the program. Plenty more on that discussion in just a moment. Equity futures at the moment negative by 1/3 on the S&P. Yields are higher by 2 basis points on a 10-year, 373.38. Under surveillance this morning, price for perfection in the bond market.
We still think that the market is overpricing cuts for next year. They came into the meeting thinking that they want to move away from restrictive policy and to front load some of those cuts. But from here on, they're going to be very deliberate and data dependent. The front end is going to continue to offer a lot of value for investors to park their cash in.
So here's the latest in the bond market. The front end anchored, long bond yields backing up over the past few sessions as markets begin to embrace a soft landing in a much bigger way. Matt Hornbeck of Morgan Stanley writing, Powell emphasized the FOMC's commitment to being data dependent and being nimble. We see a string of 25 basis point cuts through mid-2025. The Fed has not fundamentally changed its view on the economy. It remains healthy. Matt Hornbeck joins us for more. Matt Hornbeck, do you still believe this economy ultimately remains just that, healthy?
Well, John, that's certainly our baseline view. And I would just say, I'm not sure that this was a front loading of rate cuts. I think that the way that Chair Powell had to sell this to the committee is that they really should have cut rates in July by 25 basis points. They opted not to do that. And so this was really a catch-up cut. And that's what you see, I think, reflected in the dot plot as well. It's probably the case that 2 of the 19 FOMC participants did not want to cut rates 50 basis points at this meeting. You could also make the argument that an additional 7 did not want to cut 50 basis points at this meeting. And so the way that I think they all had to buy into this is that, look, we probably should have cut rates by 25 basis points in July. The data that we received subsequent to that meeting made the case that we should have done that. We didn't, but we're going to catch up now, and we're going to deliver a 50 basis point rate cut, and that ultimately is just 2 25s 6 weeks apart. And then they're just going to continue to focus on that type of pace, unless, of course, we're wrong on the health of the economy and the labor market deteriorates further.
Much of what you said, Matt, of course, echoed in the news conference with Chairman Powell. We heard it a few times when he said words like recalibration, when he went out of his way to suggest that ultimately that 50 basis point move doesn't set the tone. It's not going to be the pace of this rate cutting cycle. We've had a few bond investors, Matt, come on the program and make the suggestion that maybe this bond market is now fully priced for rate cuts from here, that perhaps you can't get much more of a rally. The bigger part of the move is behind us. Matt, I'd love your thoughts on where we're priced at the moment, just in terms of the dot plot, and whether the Fed's rate path, you consider it to be the ceiling for rates or the floor. How do you think about that?
Well, the Fed's dot plot has an unfortunate history of not being right very often, and I think investors are aware of this. And so when we compare the market price to the dot plot, we have to understand that the market price incorporates both expectations of investors, which tend to be determined by the dot plot, or at least guided by the dot plot, but investors also would be the first to admit that those expectations change often. So we look at the market price relative to the dot plot as evidence of a risk premium. If you ask investors if they're wrong, which direction are they likely to be wrong? And most, I think, would tell you today that if their expectations for a string of 25 basis point rate cuts don't play out, that it's likely to be that the Fed moved more aggressively back towards neutral. What's in the market price, John? You asked me this. I think, to me, the market is pricing that the average outcome of all possible scenarios is one in which the Fed moves more quickly back to neutral, and in doing so, helps the economy avoid a hard landing.
Does this make you less inclined to buy long bonds then, just simply because, on all things being equal, that would potentially keep inflation more significantly in the system and growth more prevalent?
Lisa, I think it's probably going to take more than a string of 25 basis point rate cuts to change the economy in the near term. Again, policy operates with the famously long and variable lags, and I think just the performance of the economy over the past 12 months has shown that in spades. The Fed began hiking rates in 2022. They did so quite aggressively. We really haven't seen the economy slow to a notable degree until very recently, when labor market data has disappointed to the downside. So I think it will take some time for these rate cuts to impact economic activity. And so, the Fed may not be on a preset course, as they like to say, but neither is the economy. The economy is not on a preset course. We have to monitor the data as frequently and as carefully as the Fed do from month to month.
One of the most confusing aspects of this entire narrative is what happens with the dollar. If you push it through the FX channel and you start to look at whether you do see a correlation with further rate cuts and dollar weakening starts to break down when you start to look at growth differentials, when you start to look at what's going on in Europe, what's going on in China versus what's going on in the U.S. How do you understand that at a time where people are heavily positioned to dollar weakening going into year end?
So, Lisa, I think this is where you have to keep an eye on not just rate differentials, which are famously known for working in some periods and not working in others. You need to also look at what the story in the rate market is suggesting. And how I interpret that story is, at the moment, the market is still pricing for a soft landing based on the idea that the Fed moves a little bit more quickly back to neutral than perhaps they thought 6 months ago. But if that's not right, if we actually end up moving into a hard landing scenario where the Fed almost certainly would have to take monetary policy into accommodative territory, that's a different environment than currency investors have been thinking about over recent months. And so I would say that if the terminal rate pricing for the Fed moves significantly below this 2.75% to 3% range, then the dollar should behave much differently than it has up until this point. By the same token, if the terminal pricing for the Fed moves back higher, where maybe the Fed doesn't have to cut all the way back to 2.75 or even 3%, then I think the dollar will benefit in that environment. As interest rates move higher, we think the dollar would probably move higher again. But we're right on that fence. And so currency investors, we're advising them to be very, very careful about how they position in the dollar today.
Matt, 20 years ago, there was a young man called Matt Hornback trading JGBs out of Japan. Can we finish on Japan and dollar yen? Matt, what do we do with dollar yen here? Big breakout today, back to 144. How are you thinking about that particular currency pair?
Yeah, well, aside from my standing recommendation for everybody that has not been to Japan to go now, while the yen is still very cheap, I would say, this is an interesting moment for the Bank of Japan. They've had a long history of hiking rates into global slowdowns, and therefore they've had to quickly stop hiking rates. They find themselves at a similar period of time. I think Governor Ueda made it clear in his press conference remarks that he does have an eye on the U.S. economy. If the U.S. economy does slow more quickly and dollar yen likely continues to move lower, then maybe the bank doesn't have to continue to raise interest rates. I think so. The movement that we saw just overnight in dollar yen was primarily related to the idea that this was a bit of a surprise. I don't think many investors expected him to be quite as dovish as he sounded today.
Matt, you're awesome. It's good to catch up. Appreciate your experience, as always. Matt Hornback of Morgan Stanley. Just on dollar yen at the end there, 144.28. Up next on the program, we'll catch up with Sam Stovall of CFRA. We'll speak to Christian Weatherby of Wells Fargo, Veronica Clark of Citi, and Tom Becker of BlackRock. The third hour of Bloomberg Surveillance, just around the corner.
What prompted you to want to get out of just doing surgery to be an administrator and a hospital leader?
Watching others who did it well. I had a dean who recruited me from Birmingham, Alabama to Minneapolis, Minnesota, which is a big jump to convince me to move my family. I realized over time that my training as a surgeon brought a set of credible things to the table. One, if surgeons have a measure of emotional intelligence, not much of our training reinforces that. It reinforces skill, not necessarily emotional intelligence. But if a surgeon has some self-awareness and emotional intelligence, what they bring to the table of leadership are three fundamental things. Number one, they do everything in teams. Their operations, their patients they see is all team focused. Number two, they value process, but they hold themselves very much accountable to execution. They understand that it's good to explore a patient, but what really matters is that you take the tumor out. And then number three, they make difficult decisions on incomplete information. Those things I realized that I could bring to the table as a leader if I had a sort of a passion for working with people and had some sense of self-awareness.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. The top names in tech are on Bloomberg.
A large number of countries are subsidizing their regional data centers so that they could become able to build out their AI infrastructure. They recognize that their country's knowledge, their country's data, digital data, is also their natural resource. Not just the land they're sitting on, not just the air above them, but they realize now that their digital knowledge is part of their natural and national resource. And they ought to harvest that and process that and transform it into their national digital intelligence. And so this is what we call sovereign AI. You could imagine almost every single country in the world will eventually recognize this and build out their AI infrastructure.
Nobody covers technology like Bloomberg. Context changes everything. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
I think one thing is clear. This is a Fed that is willing to surprise the market.
Trend lines here are still a bit disconcerting, so I think it makes every sense in the world for the Fed to start cutting interest rates.
The other takeaway is that the bar for moving rates lower is not that high.
From here on, they're going to be very deliberate and data dependent.
Let's see people move away from this Fed narrative to where's the economy, what do earnings look like, and I think that's going to be okay.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
That really is the next 6 weeks. It's about the economic data and it's about the earnings going into the election in November and that big Fed meeting on November 7th. From New York City this morning, good morning, good morning. The third hour of Bloomberg Surveillance starts right now. Coming off the back of all-time highs on the S&P 500. Equity futures pulling back just a touch all morning. On the S&P, on the NASDAQ, on the Russell, we're down by anywhere between 2 and 0.3%. There's a big debate on Wall Street right now. Are we fully priced in the bond market? Do you look at the Fed rate path implied by the dot plot as a ceiling for rates or a floor? Or as Matt Hornback of Morgan Stanley puts it, if they're wrong, in which direction will they be wrong?
And they have a history of being wrong. And ultimately, this is the reason why when we start the next earnings season, that's going to be very much in focus. Right now, people want to hear what companies have had to say. You talk about the knife's edge and the lack of clarity that you've seen in a lot of the economic data. Frankly, when you talk to executives of big companies, they have the same lack of clarity. What is your biggest question? They say, which direction the consumer is going to fall in? Because right now, you've got mixed signals on both sides.
So FedEx, mixed signals. Did you get anything definitive out of a move, seeing FedEx down by more than 13% in the pre-market?
I see a definitive move for FedEx in terms of the macroeconomic implications. Really, the key question for me is how much are they losing market share and, frankly, the ability to charge more for faster shipping to the likes of Amazon, to others. You know, how much is this a sort of secular economic story versus a specific competitive one? Typically, this has been a macroeconomic story. So the fact that people are sort of shrugging this off, maybe this sets the tone a little bit, but for the most part, people are kind of not considering it with the same kind of clout that they might have in the past.
In the middle of October, we'll get bank earnings, kicking off with JP Morgan, I think on October 11th. And a big question we've got after conference season, will we be talking about interest rate risk at these banks in the other direction, or will we be talking about credit risk, given what we heard from Ally Financial at the Barclays Global Financial Services Conference?
Which it is matters a lot for the sort of read through to markets. If it's interest rate risk, Okay, net interest income going down because yields are going down, not going to necessarily shake the needle when it comes to the larger market read-through. Credit is different, and we saw that with Ally Financial, which is not a major financial institution, but the fact that they came out and raised questions about rising delinquencies and the health of the credit in consumers, you hear more of that from some of the majors, that could resound pretty loudly across the entire market.
That's the outlook for earnings. Typically, we're not interested in the palace intrigue of the White House or anything like that. This week, I really am around the Federal Reserve. What happened at that two-day FOMC meeting? Did Chairman Powell come in, bang the table and say, we're going 50, we need to catch up? The Fed speak that starts today and continues next week. I think if you get some interviews with some Fed officials over the next few days, I think it's a lot of questions to ask. And it begins with the Philadelphia Fed President, Patrick Harker, a little bit later on in an address at about 2 p.m. Eastern Time.
In an ideal world, it would be great if they could answer this question. How much did the committee feel bullied by the fact that the market had moved completely and priced in a 50 basis point rate cut at this meeting, indicating that they would be sort of more consensus if they went with that position at the meeting this week?
And how much of that pricing came from some articles that may or may not have been encouraged by the Federal Reserve Chair himself, Jay Powell?
Yeah, exactly. That's exactly where I was going. Yeah. And that is sort of one key question that we are never going to answer probably, but is ultimately the issue that people are looking for. What do they look for in terms of tea leaves for what they do in November 7th? I mean, frankly, anyone's guess at this point, but for a lot of reasons. But, do they look toward the two-year yield? Do they look toward rhetoric out of just Jay Powell? How about everybody's? Or do they look for articles released during the quiet period that may or may not have been influenced by a certain...
I think we know what happened this time around. We just cut interest rates by 50 basis points this week, with jobless claims delivering a massive downside surprise, still in the low 200s.
It was a recalibration, John. It was a recalibration.
I heard that on repeat.
It was a recalibration. I love what Bank of America credit analyst said. This was the most demanded Fed cut since the early 1980s, given how far the front end of the Treasury yields had fallen. This feels like a Fed that craves to be on the right side of the market. So then it goes to the question of how do you get that market to cooperate at a time where there are a lot of mixed signals? And herein lies the question around some of the messaging.
Credit spreads are tight and equities are at all-time highs. Equity futures pulling back from those levels this morning. We're down 0.2% on the S&P 500. Yields a little bit higher once again by a basis point or two. The 10-year 3.7319. Coming up this hour, we'll catch up with Sam Stovall of CFRA as stocks come off record highs. Christian Weatherby of Wells Fargo as FedEx slumps on a grim 2025 outlook, and Veronica Clark of Citi on why she disagrees with the Fed on recession risk. We begin with the big issue, stocks stalling at all-time highs as Fed rate cut euphoria begins to fade. Sam Stovall of CFRA saying, we remind investors that wanting has traditionally been more profitable than having. In the average 12 months between the last rate hike and the first rate cut since 1990, the S&P 500 gained an average 17.7%. In the 6 months after, the S&P gained an average of only 2.2%. Sam joins us now for more. Sam Stovall, is this time different?
Good morning, Jonathan. Well, when you have to look at the averages, you have to, like leaves of an artichoke, sort of peel to look at the heart of the matter. And if you're dealing with the S&P 500, then yes, you actually have several times in which the market did fairly well. But at the same time, there's a relatively equal number of bear markets that ensued, 1990, 2001, 2007, 2020. So essentially the question now, as Lisa was raising, was, is this truly recalibration, or are we simply improving the likelihood of avoiding a recession?
Sam, this is the answer from Brian Bowski at BMO. It's raised his price target to 6,100 in the last 24 hours. This is a quote from him. We continue to believe a soft landing is the most likely economic scenario, which makes the current environment most comparable to the mid-90s. He goes on to say this, a period where the index was able to sustain a greater than 20 times multiple for several years. Sam, can you tell me how you're thinking about multiples on this equity market and whether we can sustain these kind of levels?
Well, I do think that we are headed for a soft landing. Our economists are projecting 2.7% real GDP growth for this year, 2.2 for next year, 2.0 for 2026. And investors continue to believe that the U.S. is the best place to be investing at this point. I think, however, that when you do talk about valuations, yeah, you have to sort of tiptoe around that. Right now, the S&P is trading at a 33% premium to its 20-plus year average forward PE ratio. Tech is trading at a 55% premium, but let's remember it's down from 78% premium in mid-July. So I think we're going to have to see some better than expected earnings reports ahead. And also, I think a lot of tech analysts are justifying the shorter term PE ratios based on the fact that they're now beginning to look to 2026 earnings.
You pointed to the fact that we need some earnings outperformance. We didn't get that from the likes of FedEx. And a real question for a company that traditionally has been an economic bellwether. Why is this time different? Why are people dismissing this as an idiosyncratic story rather than a tell on the consumer?
Well, certainly FedEx being a transportation company, and those who do hearken back to the Dow theory that you need the transports to be able to confirm whatever move is made in the industrials, that is a concern. I think when you look also to Q3 earnings estimates, on June 30th, the street was looking for a little more than 8% growth, but now it's about 5.5% growth. Granted, you had some of that forward earnings growth taken away with the better than expected Q2 results. So when you look to the full year this year and next year, those numbers really didn't move too much. So I would tend to say that this Q3 earnings reporting period will be very important and pivotal to where the market goes from here.
You pointed to the statistic that after the first Fed rate cut, typically stocks don't perform as well as they did in the prior 12 months. And this is one of the key debates that we've heard from a lot of people who've come on the show, which is essentially, do you go longer into stocks than bonds, or do bonds hold more value in a cutting cycle, especially when usually it comes with some economic weakness? Where do you fall on this?
Well, the right answer to most financial questions is that depends. Depends on whether you believe that a recession is around the corner. If you do, well then, which we don't, then you really want to be focusing more on bonds as a ballast for your portfolio, as a way to maintain the value of your portfolio. We believe that we're headed for a soft landing, so our belief is that you don't want to be adding too dramatically to the longer bond at this point, because we expect it to average about 360 in 2025, so not much lower than where we are right now. Our belief is yes, you're probably going to be seeing some softness in the month ahead because seasonal activity, September and October are the two negative months during election years, and October traditionally has about 35% more volatility than the other 11 months of the year. But we typically see end of election year euphoria once the uncertainty has risen. So over the next month or so, I would say some of the more conservative areas like gold, which has traditionally done fairly well 1 month after the start of a new rate cutting cycle.
Okay, let's go there. You mentioned gold, so I can talk about it without being accused of being a perpetual gold bug, which I'm not. But there's a question of what the message is that gold is sending. Is it related to inflation? Is it central bank buying and debasement of the dollar? Is it a fiscal hedge? What's sort of the read-through for you?
Well, I would say primarily it's because of the lower interest rates. When you have gold, basically pays no dividend. It costs money to store, and because of the last 6 rate cutting cycles since 1990, we had bear markets occur 4 times within 12 months. Then, yeah, it is a store of value and nervousness as well. So, companies like Royal Gold, like Newmont Mining, we think should do fairly well in the period ahead, and typically in the very short term they continue to advance as the uncertainty remains.
Sam, we've got to leave it there. It's got to catch up. Sam Stovall there of CFRA, with equity futures recovering somewhat, down about 0.1%, and looking ahead to earnings season there. A few dates for you. October 11th, that's when earnings from JP Morgan comes out. 1 week later, October 18th, that's when numbers come out from Ally Financial. The reason we keep talking about those two names, a week or so ago we had the Barclays Global Financial Services Conference, and at that conference we heard from 2 speakers. Dan Pinto of JP Morgan making the point that maybe analysts were a little bit too optimistic about earnings given the rate path, and then we heard from Ally Financial warning about what was happening in the auto lending book at that company. And we both asked the same question: what's going to dominate earnings season for the financials in the next month or so? Is it going to be credit risk, or interest rate risk?
The fear in markets is that it's credit risk. And what was interesting to me is JP Morgan's the biggest bank in the United States, arguably in the world, when it comes to international payments. A real question here about credit quality that you're seeing at some of the smaller players. The fact that Allied, that sort of was the real question highlights that.
Equities right now down 0.2% on the S&P 500 with an update on stories elsewhere this morning. With your Bloomberg Brief, it's Danny Berger. Hey, Danny.
Hey, John. The infamous 3 Mile Island nuclear plant in Pennsylvania will return to service in 2028 and sell all of its output to Microsoft. It currently has 2 closed units, one shut a half-century ago after the worst U.S. nuclear accident in history. Constellation Energy will reopen the other reactor, which shut in 2019 because it couldn't compete economically. Microsoft agreed to purchase the energy for 2 decades to power its AI boom. It declined to disclose financial terms. The Harris campaign is returning to Hollywood for its latest media event. The vice president held a town hall in Michigan that was hosted by Oprah Winfrey. Celebrities like Julia Roberts, Jennifer Lopez, and Chris Rock joined Americans sharing experiences with gun violence and abortion restrictions. Harris said she hopes to be a unifying president, repeating promises to boost small businesses, sign an immigration bill, and restore federal abortion rights. China has begun cracking down on illegal medicines similar to diabetes and obesity treatments like Ozempic and Wegovy. The gray market has been catering to growing demands for such treatments during a global supply crunch. Knockoffs of the popular medications have been sprouting up around the world as these companies struggle to keep up with unprecedented demand. That's especially the case in China, where Novo Nordisk said it would limit sales. And that's your brief, John.
Danny, thank you. We'll catch up with you again in about 30 minutes' time. I think you said something about supply chains in China earlier on. Fake Ozempic.
Yeah, well,
scary stuff.
Does it make you grow another arm? I mean, seriously, especially given some of the side effects of even the name brand things. Can you imagine what some of the side effects are of some of these other?
Not good. Thanks. The good news is that they're trying to clamp down on it. That's the good news.
Yeah.
The bad news is that this has been a problem for a long time.
Which is a reason why increasingly supply chain security is going to be a question, not just for international government agencies, but also for companies. How do you get away from trying to be either the subject of counterfeit theft, people knocking off your product and giving it a bad name, and B, how do you make sure that all of your sourced materials are okay and are actually what they say they are?
We've got some stocks to get to. Up next on the program, the morning calls. Plus, we'll catch up with Christian Weatherby of Wells Fargo as FedEx falls on a weak outlook. That stock is getting absolutely slammed. The broader equity market better than okay. Your S&P 500 coming into Friday at all-time highs. On the Russell, the small caps on a 7-day winning streak, the longest daily winning streak for the Russell, going back to March 2021. From New York, this is Bloomberg.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
As we
we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
We are 1 hour, 12 minutes away from the open and bound. The cash open just around the corner. Equity futures pulling back just a little bit. No drama all morning. We're down just 0.1% on the S&P 500. Let's get you some morning calls. First up, B. Riley initiating coverage of Snap with a neutral rating, seeing brand advertising as an overhang on growth. That stock is down just a touch by 0.2%. Next up, Baird raising its price target on Nike to 110, expecting shares to benefit from a change in the C-suite. We're up there by almost 8 full percentage points in the pre-market. And finally, Morgan Stanley downgrading FedEx to underweight, pointing to disappointing results and future headwinds. That name is down by more than 13% this morning. Let's stick with FedEx. Christian Weatherby of Wells Fargo maintaining his equal weight rating and $300 price target, writing, Express fundamentals are under pressure and we see risk for another guidance cut, which may overhang shares. Christian joins us now for more. Christian, welcome to the program. Let's talk about that very real risk. Are you suggesting that maybe those cuts aren't deep enough?
Yeah, we are. If you look at what they did in the first quarter, they missed numbers and seasonality by more than $1 per share on earnings, and the company cut their guidance at the midpoint by only 50 cents. We know their fiscal second quarter, which we're in right now, is going to be under some pressure as well because of a couple of dynamics with the U.S. Postal Service contract leaving, as well as a calendar shift moving Cyber Week into their third quarter. So we do think that they're putting a lot of emphasis on the back half of the year and really looking for an improvement in the industrial economy to be able to fuel that. And we're a little bit skeptical.
Christian, you mentioned the comps there. The holiday shopping period's a little bit shorter. Does that make a big difference to this company?
So I think there's some puts and takes. So obviously a shortened holiday season creates a little bit more of a frenzy of activity. That can be expensive for them to manage. So something we're watching. That being said, they've also implemented the largest demand surcharges, peak demand surcharges that we've seen over the course of the last many years. And I think that has the potential to offset it. So you could have a decent amount of revenue coming from those surcharges to try to help offset the costs.
Christian, how much is this a broader macro issue where consumers are just not willing to pay to get things more quickly? And how much is it that they've gotten spoiled by Amazon Prime and Walmart Plus and all these other subscription services that enable them to get some of those delivery perks without paying more?
I think that has been a sort of long-term headwind that we would expect to see continue, that the consumers just are not sort of educated to pay for the shipping, pay a premium for that premium shipping that they all come to expect. And so I do think that that's a longer term headwind that we would continue to see. I think what we saw in the quarter was probably a little bit more focused on international mix shift, where we are seeing more volume moving into their economy products, which come at a lower revenue per unit. So that had been probably the bigger issue. Volume overall didn't miss by all that much. So we had this mixed trade down that was probably a bigger piece of the overall problems that they had in the quarter. So a little bit of that longer term e-com issue and the unwillingness to pay, but I think it probably was a bit more of this mix and a little bit more internationally focused.
Christian, you used a phrase there. I'd love you to explain it. Educated to pay more. Is that just not advertising well enough, not targeted, not sold? What does that mean?
Well, I mean, I think that what it really means is that the customer of FedEx or UPS is really the retailer, and then ourselves, those who consume e-commerce, are customers of the retailer. And there is a little bit of a disconnect between what ultimately FedEx and UPS charge the retailers and what we see as consumers of the product. And so I think a lot of folks just don't understand what it costs ultimately to move the really one of the aspects to it. We the years that FedEx and UPS could do a little bit better job getting connected with the consumer. There's an enormous amount of data that both companies have on what we consume on a regular basis. And I do think there could be some better connections, better education there. But the reality is the customer base is the retail player. And it's a little less clear to us consumers where that shipping cost is being embedded. Is it the price of the good? Are we paying for shipping? Are we not paying for shipping? So I think that's the disconnect that we see to some extent.
That's fascinating, Christian. I'm just wondering, typically this is a name that has a macroeconomic read, a sense of what's going to happen with consumers and what their willingness is just to spend more generally. Is this time different based on some of the trends that you were talking about?
You know, it is and it isn't. You're absolutely right. This is a macro bellwether, and when we see that is quite volatile historically, and so when we see slowdowns, particularly in the industrial economy, we do tend to see earnings falter for this company. I think there is that. I don't want to understate that. The reality is we have seen some overall weakness in industrial activity that showed up actually a little bit more pronounced in the company's freight trucking business that ended up missing volume expectations by a decent amount. And we are seeing that across other parts of our coverage where industrial shipping activity has been slower. So I do think that there is a connection to some degree, and we have to be careful for that. You know, part of the risk that we see in the second half guide that the company has put out there is they're assuming an acceleration in macro activity. And while we're hopeful that we will see that, it's a little hard to underrate at this point.
Christian, let's talk about your rating at the moment. It's an equal weight. It's a price target of 300. 300 is where the stock closed yesterday. We trade at 260 right now. So if I mark to market your call, it now looks like a buy with a price target of 300. What gets us back to 300? We talked a lot of the negatives. What are the positives here that help this stock?
Yeah, I think there's a couple of things here. So, and probably the biggest one is the potential spin of that freight trucking business that I mentioned before. If you look at FedEx from a sum of the parts perspective, their freight LTL business would be, in theory, significantly more valuable from a multiple basis based on where the peers are trading now than the overall parcel piece of this business. And so I think as we get closer to a decision around the spin, the company has said they'll let us know by the end of the calendar year. And given the weakness that we're seeing in some of the other pieces of the business and the stock being under pressure, we think the likelihood of that spin is actually growing.